Welcome. I am the Empowerment Auntie, and I am here to help you to reach your career, money, and relationship goals. Today, we are going to be talking about personal finance. And in the personal finance, we will be talking about quite a few topics. Saving money, because Forbes advisor said that in 2024, only 25% of Americans had $1,000 or more saved. And that is something that we want to change. So I am here to help you to save money and to maximize your financial life. The first thing that you need to do when you want to maximize your financial life is to know where your money is going. And it helps to have a budget. A budget, some people think is a bad word, but a budget is just a plan for how you expect to spend your money. And a common plan is the 50-30-20 plan. And basically what that is you take your take-home income, and that is considered 100%. You take 50% of that, and that is used for your necessities. So that would be like your housing, your transportation, your food, your utilities, your tithes. And then 30% is for your wants. So those nice things that you want, that would be the 30%. And 20% is your savings. You should not be saving less than 20% of your income if at all possible. And if you're saving less than that, try to work your way up to at least 20%. And one way you can do that is to call every year to try to negotiate different plans or packages that will reduce your costs on your cell phone, your cable, your security alarm, your internet, your credit card interest rates. A lot of times those will be adjusted for you if you only ask, if you are a good customer. So make it a habit, put it on your calendar to ask once a year for them to lower your rates. We are going to talk about credit scores and credit reports as well. There are three major credit bureaus: TransUnion, Equifax, and Experian. And they are the repositories of credit information that businesses use to determine whether or not you are credit worthy. And the credit report is the file of personal information that they have on you. As part of that file, you get a credit score. And the main credit scoring agency is FICO, and they have the score that businesses use to determine your credit scores. The credit scores for FICO range from a low of 300 to a high of 850. And the breakdown is this. A poor is 300 to 579. Fair is 580 to 669. Good is 670 to 739. Very good, 740 to 799. And exceptional, 800 to 850. And then next to that, you see the percentages of people who have each score. Now, when it comes to your credit reports, the credit bureaus have similar information, but it may not be the exact same. Each bureau has its own file on you. You are entitled to get a copy of that credit report for free every year from all three of the major credit bureaus. And to do that, you go to www.annualcreditreport.com. And that is the website that was initiated by the federal government so that you can have a secure site to request your credit reports. And you can get one per year, so I recommend staggering them and getting one every 4 months so you can get a running view of what your credit profile is on your various credit reports. So maybe in January you might get it through Experian, and then in May you might get it through TransUnion, and then in September you get it through Equifax, and then you start over again the next year, and that way you're getting one of each free every year through that website. There are different factors that affect your credit score. Payment history is a big part. The length of your credit history is a significant part. Your credit utilization ratio, which is how much of your credit you are using. So if you have a $1,000 credit limit, for an example, if you've used all 1,000, that is maxing out your credit, available credit. That's a 100% utilization ratio. If you have used only 300 of that 1,000, then you have a 30% credit ratio. And the companies like to see a credit utilization ratio of 30% or below. Whether your credit is new or you have new credit also factors into your credit score. And the credit mix. They like to see a variety of different types of credits. Maybe a credit card and a mortgage and a car payment or something like that, to make sure that you are a well-rounded person that is credit worthy in all different realms. But the payment history is the most important. You can dispute any negative items on your credit report because the law, the FDCPA, Fair Debt Collection Practices Act, does say that everything on your credit report has to be 100% accurate. If it is not, you can request that it be removed, and they will have to remove it. So if they cannot validate that it is correct, they have to remove it. If it's a legitimate debt, like say you bought a car and it's on your credit report, but they do something wrong and it's not on your credit report correctly, you can have it removed, but you still have to pay for the car that you're driving. Just because you have it removed from your credit report does not mean that you are not responsible for it. Now, a lot of people are interested in credit repair if they have things that are negative on their credit report. So I want to tell you about Collection Shield 360. Let me preface this by saying I will be mentioning a lot of websites and services during this video, and this will be part one of a two-part series, but everything that I mention in both of these two parts, I have not been paid to advertise these people. These are just services that I have learned about during the course of reading financial blogs, and I've heard about through some people's personal experience, and so they are things that I am letting you know about. So collectionshield360.com is a website. It is free, and they offer various services for you. one of which is disputing negative items. And they can dispute it on your behalf. You, of course, have to give them permission to do so. And they have the majority of what they dispute is removed. And so that will work in your favor, and it will increase your credit score. They also help you because they give you some protection against harassing collectors. Under the law, the FDCPA, Fair Debt Collection Practices Act, there are certain rules that debt collectors have to abide by. This is a federal law. And if they are not abiding by that law, then Collection Shield 360 can help you. They can take them to court on your behalf, or they can negotiate a settlement on your behalf, because the Fair Debt Collection Practices Act awards you based on your actual damages, which can be like lost time at work, it can be hospital bills, those type things. If you suffer actual damages, even if you cannot prove any damages, you can ask for up to $1,000, and the law is on your side with regard to that. With regard to that $1,000 compensation for every violation. So the FDCPA also requires that all legal costs, court fees, attorney's fees be paid by the violating collector. So that means that there ends up being no money out of your pocket if you can prove that they violated the FDCPA. And that's what Collection Shield 360 helps you to do. They have lawyers that can go to bat for you, and if they win on your behalf, then there is a small percentage of that they take as compensation for their work on your behalf. I believe last time I checked it was like 25% that they take, but the other $750 is yours that you didn't have to work for. They will do that work on your behalf. And if they only get paid if they win for you. And in addition to that, they do have offers of like credit cards and loans and things like that. And if they recommend you to one that you apply for and receive, then the financial institution that they referred you to will also compensate them for that referral. So we are going to talk a little bit about how to build your credit, some credit building techniques. Watch your credit card balances. We already talked about the credit utilization ratio. And to the extent possible, eliminate those balances, pay them down. And when you do so, if you're going to charge a small amount, I know of some people who would, for an example, charge $100 on the card and then pay off the card in full before the bill cuts. That really doesn't give you the benefit that you're looking for. What you want to do is to make it in payments. We know that, yes, you can probably pay off that $100 in one payment, but the companies that offer credit are looking for a history of on-time payment. And so instead of paying it off before you get the first bill, stretch it out for 3 months. Make sure you pay on time and pay for 3 months. And then that shows more of a history that looks more credit worthy than just paying it off in one lump sum. In a way, it's kind of counterintuitive, but that's the way the system works. And one thing you should do as well is leave old paid off debt on your account. Sometimes people are like, oh, that account is closed, I don't want it on my credit report anymore. But that goes to the credit history age. And we've already talked about how that plays into your credit score. So you want to show as long a history as possible, because the longer the history, the better. If you are making a major purchase, try to put your inquiries close to each other within 14 days or so of each other, because then they will be counted as one ding on your credit score. Because normally when you apply for credit and a company runs your credit, it counts, it's called a hard credit pull, and it affects your credit score. There is a very slight decrease in your credit score temporarily. And in order to minimize that, apply, not in batches exactly, but close in time frame within a 14-day period, because then it'll just be considered one inquiry and it won't ding you multiple times. So one thing you want to do also is don't hint at risk. And what I mean by that is don't do things that are out of the normal for you that might make it look like you've come up on some financial difficulty. Like if you're using your credit card at a pawn shop, they might think that maybe you're having some difficulty. If you use your credit card for a divorce attorney, they may think maybe you're having some difficulty. If you always carried a 10% credit card utilization ratio and all of a sudden you've maxed out 2 cards, they might think that you're having credit or financial difficulty. So to the extent possible, try to minimize those things, because they proactively look for risks, and if they think you're risky, then they can reduce your credit limits, which will then reduce your credit scores, because it increases your credit utilization when you have lower limits. So be careful with those cash advances, using your credit card at cash advance places and things like that. Another way you might want to increase your credit is through a website called Self, www.self.inc, and Self is SELF. They have a credit builder account that allows you to save. It's a savings account, but it builds credit while you save. And you fund the savings account in the amount that you choose, and you make monthly payments that they then report to all 3 credit bureaus. And they can also report rent payments to your credit bureaus, and you end up with more savings. Those payments that you make are just added to your savings. So you, in effect, are paying yourself. And so you are building savings while building credit. They do charge a small fee for doing that, but it does increase your credit score relatively quickly. Another thing you can do is use Experian Boost. This you may have heard about, but there are certain things that don't report to credit bureaus normally, And those are things like rent, cell phone, utilities, insurance, streaming services. And if you use Experian Boost, which is free, they do report those things to your credit report, which does make it seem like you have more lines of credit, which is a good thing. And it also shows positive history in more places, which is a great thing. So when you apply for that, you also get a free Experian credit report and FICO score. And it includes Experian credit monitoring and alerts. So again, I have not been paid to advertise anything. These are just things that I think you may be interested in. Another way to increase credit score that many people don't know about is piggybacking on someone else's account. If someone has a very strong credit history, and we'll use a credit card as an example, and I'll use a parent as an example. If a parent has had a credit card for 20 years and they have had a perfect payment history on that card for 20 years, a lot of times the parent will put their child as an authorized user on the account. The child may be 6 or 7 years old, but they will put the child as an authorized user because by having them piggybacked on their account, they're building good credit for their child at a young age. So by the time the child hits 18, they have a long, stellar credit history. And obviously the parent is not going to hand a credit card to a 6 or a 7-year-old. But they can have their name on it, and it can give the kid a head start when they graduate from high school and go out either to college or to work or whatever it is that they choose to do. If they choose to buy a home, they will have a leg up on their peers because of this solid credit history. So we will talk a little bit about credit monitoring because there is a lot of identity theft nowadays. And a lot of times your information might be in a breach. And if that is the case, you may need to monitor your credit so that you'll be aware if someone tries to fraudulently open an account using your credentials. And there are a few ways to do that. CreditKarma.com gives you free credit reports, free scores, and free monitoring, as well as a lot of information about credit and how to improve your credit. Credit Sesame is similar, and they actually add free identity theft protection. And they use a different credit bureau than Credit Karma, so you may want to get an account with both. They both are free. And that allows you to check multiple credit bureaus because creditors don't check all three bureaus when they run your credit. They usually are affiliated with one of the major three, and they check that one. And so it helps to monitor more than one credit bureau. You also can get free credit monitoring from Experian. If you go to www.experian.com/credit/credit-monitoring, you can apply for the free credit monitoring. In addition, if you are a AAA member, they have a service called Protect My ID that they run in conjunction with Experian, and that is free for AAA, American Automobile Association members. And the website for that is www.aaa.com. Experian ID theft. In order to fight identity theft, you may also want to consider a credit freeze. A credit freeze is a free service that is offered by all three of the major credit bureaus. It allows you to seal your credit reports, and you will typically be assigned a PIN number. And if someone tries to apply for credit using your credentials, your social security number, you will be contacted by the credit bureau to ask you, is this really you? And you will have to provide the security PIN in order for that transaction to go through. So that is a way to help reduce your chances of being a victim of identity theft. And freezing your credit reports has no impact on your existing credit lines. So for an example, if you have a credit card, you can still use the credit card like you always have. It does not lock your credit card. And residents of certain states can also freeze the credit of their minor children. You can visit the National Conference of State Legislatures website to see what the law is in your state, because that is not available in every state. And I have the web address for you. It's a long web address, so I'm not going to read it off in the video, but you can go to my website, empowermentauntie.com, and just put in your email address, and I will email you a copy of all of the links that I am mentioning in this video and in part 2 of this series video as well. When you do a credit freeze, it is imperative that you freeze your credit with all three credit bureaus, because like I said, some creditors run through Experian only, some run through TransUnion only, some run through Equifax only. So if you've only frozen your credit with one and that creditor runs through another bureau, then it will go through immediately because there will be no credit freeze in effect. So make sure you freeze it on all three of the major credit bureaus. And for those of you that live in Kentucky, Nebraska, Pennsylvania, and South Dakota, please keep in mind that they remove your credit freeze automatically after 7 years in these 4 states. You can renew it, and again, they are free, but just keep in mind that it only lasts for 4 years in those. It only lasts for 7 years in those 4 states: Kentucky, Nebraska, Pennsylvania, and South Dakota. In the other states, your credit freeze will remain in effect permanently until you request removal. So, the next thing we want to talk about is bill collection. There are time limits governing how long a creditor has to collect from you, to sue you for that debt. And those are called statutes of limitations. And I'll just use one state as an example. In Maryland, the statute of limitation requires that a lawsuit be filed within 3 years if it's a written contract, and within 4 years if the debt is owed for the sale of goods. And it's 3 years for open accounts. Open accounts are accounts that don't have collateral behind them, like credit cards. So if you have a debt that is older than that, in the state of Maryland, they cannot legally sue you for that debt. The countdown begins from the date the debt becomes due. So if it's beyond that, they can't legally collect it. That doesn't stop some unscrupulous companies from trying, because they rely on the fact that a lot of people don't know what I'm teaching you here today. And the people will either not respond and then they win by default, or the people will respond and pay because they don't want a judgment, or the people go to court and they don't mention this right, and so they end up getting a judgment against them anyway. But now that you know this, you can be empowered to fight effectively, to advocate for yourself. Negative items normally stay on your credit report for 7 years. And if a bill collector contacts you, if you admit to owing the money, or if you make a promise to pay, the time starts over. That 7-year period starts over. So be aware of that. Now, if you're doing a pay to delete, which is a process whereby you tell a collector, if you delete this from my credit report totally, I will pay you. That is something that you can negotiate with them. Some companies will do that. Some will not do that, but you never know until you ask. But when you are asking, be careful about how you phrase things, because you don't want to inadvertently start the 7-year period over and have the debt be on your credit report for a longer period of time. So, if by some chance a collector does take you to court and wins a judgment against you, there is a time limit on collecting that money. The time limit varies depending on what state you're in. And again, using the state of Maryland as an example, they have 12 years to enforce that debt, which is to get you to pay. And the timing starts from the day, the date of the judgment, which is usually the date that the creditor went to court. And if a court ordered you to pay more than 12 years ago, the creditor will not be able to enforce that debt against you, which means they won't be able to garnish your pay. They won't be able to attach a lien to your property. And so if you find that someone is trying to collect that judgment and you end up in court, you can raise that limit 12 years in Maryland. Find out what it is for your state. You can raise that as a defense to shut down the case. Now, one thing to remember is that if installments are a part of the debt, that is handled a little bit differently. If you're ordered to pay the debt in installments, the 12-year limit is counted separately for each payment due date. So if a court ordered you to pay payments, just say they ordered you to make payments for 10 years. And there's a 12-year period of when they can collect judgments. So the 12 years plus the 10 years is 22 years. 22 years later, they can be collecting on the last of the payments that were due, but they cannot collect on the ones that were due earlier, because the 12 years would be expired on those earlier monthly installments. So that is something to keep in mind. And something else important to keep in mind is that if you owe the government money, you have to pay it. If they obtain a judgment against you, whether it be IRS, whether it be whatever, the 12-year limitation does not apply, and the government can enforce that judgment at any time. So please keep that in mind. Now, I want to talk a little bit more about your rights under the FDCPA that we discussed a little earlier. Bill collectors are not allowed to do certain things. They are not allowed to call you really early in the morning or call you late at night. And the law defines that as before 8 a.m. in your time zone and after 9 p.m. in your time zone. They are not allowed to call you. Even if you owe money, you are entitled to a quiet morning and a quiet evening. So keep in mind, however, that they can contact you by phone, letter, email, or text message. And it's only the calls that are restricted during this time. They still can text you. They still can email you. The FDCPA does not specify limits on text messages. And the reason for that is because text messages weren't around when the act was first passed in 1977. Another thing to keep in mind is that they cannot call you at work if you have told them not to. So you can tell them, and it does not have to be in writing. You can tell them over the phone. And if you tell them that, they are required to stop calling you at work. So just keep that in mind. Another thing they are not allowed to do is to make repeated or continuous calls. They are not allowed to call you multiple times a day. Some unscrupulous companies still do, but this is considered harassment by the Federal Trade Commission, the FTC, and it is explicitly not allowed. So it is within your rights as a consumer to inform them that you believe that, basically to stop contacting you. It is within your rights to tell them to stop contacting you while the debt is verified. They have to verify that the debt is really yours, that the amounts are correct, that everything is in order, and then they can contact you again. But if they tell you not to call, though, if you tell them not to call, they can't call. They are not allowed to verbally abuse you either. So if they are making threats, if they're using profane language, if they're saying they're going to throw you in jail, they are not allowed to falsely imply that you've committed a crime by not paying them. And they're not allowed to verbally abuse you in any way. They also are not allowed to inform your friends, your neighbors, your coworkers, or your family members about your debt, with the exception of your spouse and your attorney. They cannot tell anyone that you owe money. And if they do, that is a violation of the FDCPA. And remember, if there are violations of the FDCPA, you can ask for $1,000 per incident. They are not allowed to collect on a debt larger than what you actually owe. And they must send a written notice of debts to you. And They have to do that within 5 days of contacting you. And it has to list the amount of money you owe and the creditor that you supposedly owe it to. And they have to explain what to do if you feel you do not owe the money. That is all a part of the law. It is required for them to do. They must honor a written request for no further contact. Be aware that if it is a legitimate debt, it does not go away just because they stop collection calls or collection efforts toward you. If you don't pay a verified debt, you could still be sued for the amount you owe. So keep that in mind. But if you dispute the debts, they do have to verify it. And fortunately for us, the credit bureaus are held to a very strict standard of 100% accuracy. And so any little thing that they have wrong can be a basis for you to request for that item to be removed from your credit report if that item is negative. So, another thing that I want to talk about is student loans, because a lot of people, the debt that they have is as a result of student loans. And so there are different ways of having your federal student loans forgiven or canceled or discharged. And this is separate and apart from what President Biden was trying to do. This program preceded him. And there are several different ways that you can have that happen, and I'm going to go into those for you. And you can find more information about this at studentaid.gov/manage-loans/forgiveness-cancellation. And again, I will have this list of links for you if you just want to drop your email address on my website. So if your school closes, if you're going to school with a federal student loan and your school closes and you don't get a chance to finish that program because your school closed, you can request that your loans be canceled, discharged, or forgiven. And these terms essentially mean that you're no longer expected to repay your loan. And so if your school has closed, you may want to apply. All of these things that I'm going to list for you that allow you to get your loans discharged, canceled, or forgiven, you have to apply for. The government is not just going to randomly just say, oh, they're a nice person, we're just going to wipe out their debt. You have to apply to them and provide your documentation, and then you can have the discharge, cancellation, or forgiveness. The second way is public service loan forgiveness. If you're working in a public service field, generally it's for 10 years or more, and it applies for nonprofits as well, generally. The loans can be wiped out. If you are a teacher, you can have your federal student loans wiped out. If you have been totally and permanently disabled, you can have your loans wiped out. If you die, your loans can be wiped out. If there was a false certification of student eligibility or unauthorized payment, your loans can be discharged. And so a lot of times this is related to fraud, where somebody, for an example, may have applied to a student loan in someone else's name without their permission, as basically identity theft. Those loans can be discharged as well. There also is an unpaid refund discharge. There is a borrower defense discharge. And in rare cases, a bankruptcy discharge is allowed. And basically, and this is only for federal student loans, if you file a separate action in addition to the bankruptcy action, an action called adversary proceeding, you request the bankruptcy court to find that repayment of the loan would impose undue hardship on you and on your dependents. And if you can convince the bankruptcy court of that, then they can allow you to discharge your loans in bankruptcy. But don't count on that. That is a very rare occurrence, but it can happen. Now, with Perkins loans, there are different opportunities for cancellation and discharge. If you volunteer in the Peace Corps, for an example, or if you are in an action program, including VISTA, if you're a teacher, if you're a member of the U.S. Armed Forces who is serving in a hostile area, if you are a nurse or medical technician, if you are a law enforcement officer or a correction officer, if you are a Head Start worker, if you are a child services worker or a family services worker, if you are a professional provider of early intervention services, then all of these make you eligible for Perkins loans cancellation and discharge. So it's important to know what kind of loans you have so that you can, if you are eligible, get those discharged. Now, one reason why people often want to clean up their credit is because they want to buy a house. And so I want to talk a little bit about buying a house and how to do that if you have challenges in your credit. There are a few things. But first, let me explain what most mortgages are made of. As many of us know, mortgage loans are the loans that you get to buy a home. And in most cases, especially for first-time home buyers, they consist of not just the principal and interest that you owe to the lender that you borrowed from, but they also roll in your real estate taxes and your home insurance as well. They put the taxes and insurance in an account that they call an escrow account, and they pay those for you, the lender does, so that they know for sure that those things get paid to protect their investment. Because if you don't pay your taxes, the house can go for sale, a tax lien sale or tax deed sale, depending on what state you're in. And if you don't insure it and something catastrophic happens, then the property can be lost, and that is the collateral for the loan that they lent you. And so they want to make sure that those things are paid as they should be. So they, in most cases, are incorporated into the loan. Principal, interest, taxes, and insurance. PITI. Sometimes it's called PITI. Principal, interest, taxes, and insurance. And so you can bring down your mortgage by shopping around for your insurance. And even after you've shopped around and gotten the best deal, it may be beneficial every couple of years to shop around again to see if it is still the best, because when your insurance goes up, your mortgage goes up. When your real estate taxes go up, your mortgage goes up. And so one thing you can do with regard to your real estate taxes is to appeal the tax assessment. And what that is, it's a process that all of the taxing governments have, where if you think that your property is not worth as much as they say it is, and you can find nearby properties that are more or less equivalent to yours, in terms of square footage, in terms of amenities, number of bathrooms, number of bedrooms, whether it has a basement or not. If it's a comparable property and their tax assessment is lower than yours, then you can make the argument, and it would be helpful to find more than one. Probably if you can get 3, that would be better. And if you can get more than that, that's even better. And you can make your case as to why you feel that these lower tax assessments should also be what your home is assessed at. And if you are successful in that, it will bring down your taxes, which will in turn bring down your mortgage. So also, of course, shop around for your mortgage loan, get the best terms in terms of repayment and interest rates and things like that. And by maximizing the tax assessment, the insurance, and the mortgage in your favor, then that will give you the lowest mortgage possible. One thing I want to tell you about is an organization that allows you to, or helps you to, buy homes. And it's a program called NACA, NACA, and it stands for Neighborhood Assistance Corporation of America. And it's a nonprofit organization, and their goal is to put people in homes of their own and keep them in homes of their own. And they have what is arguably the best mortgage in the country, because there is no down payment, there are no closing costs. Now, you'll find some loans that say they don't have any closing costs, but in reality, they just roll the closing costs into the loan, which means you end up paying interest on the closing costs. So it costs you more in the long run. But with NACA's mortgage, there are genuinely no closing costs. In addition to that, there are no points or fees, which are other charges that some banks charge. You also, with NACA, get a below market interest rate. And you can buy it down to darn near 0%. Because although you don't have to have any money down, you can choose to put money down. And for every 1% of the purchase price that you put down, it lowers your interest rate. And so you can get down to where you are essentially paying no interest, which means you will be paying off your house way, way quicker. Because with the average mortgage, you will be paying 3 times the cost of your house by the time that mortgage period is over on a 30-year mortgage. But because of the interest, and the interest is front loaded, meaning they take the majority of the interest at the beginning of the loan. So I know I personally was surprised when I was a new homeowner and I looked at my mortgage statement, the first statement, and out of the mortgage payment, there was literally less than $100 that was going toward the principal to pay down the amount I owed. The rest of it was going toward interest. And the longer you pay on the loan, the more of your principal you pay down. But at the very beginning, it is heavily, heavily weighted toward paying down interest. And so by having no interest, that is an awesome thing where you can literally have a paid off house in just a few years. You can have a 30-year, a 20-year, or a 15-year loan with NACA, and it is at a fixed rate, which is a good thing because variable interest rates can go up and interest rates can rise a lot. And if they rise, then that increases your mortgage, and sometimes it will increase it to the point where your mortgage is not affordable anymore. So, excuse me. So, the fixed rate mortgage is better for you because you know ahead of time what your interest rate is going to be throughout the life of the loan. Another good thing about NACA's program, home purchase program, is that they don't consider your credit score at all, which is amazing and it's very hard to believe, but it is true. They do want you to have a good payment history. They don't want to see any late payments in the last year. And if you do have some in the last year, they will work with you until you have a year's worth that are not late. But they don't consider your credit score at all. Another good thing is that you can buy up to a 4-unit building. You can get a single family house. You can get a townhouse. You can get a 2-unit property, a 3-unit property, a 4-unit property. And if you get one of these properties that have additional units, they will give you free landlord training to teach you landlord-tenant laws for your state to make sure that you stay on the right side of the law as you make money. And if you buy the property right, you can buy a property where the amount that your tenant pays covers your whole mortgage. So in effect, you are living rent and mortgage free. There are a few rules with NACA. You can't own a home at the time of closing, and you have to live in the home that you buy. You have to volunteer for 10 hours a year. And that to me is a small price to pay for all that NACA offers. And so if you are interested, I definitely recommend you finding out more about it, because not only do they do that, they also give you classes. You can learn basic repairs for your home to save you money, to try to keep your house well maintained, to prevent major repairs to the extent possible. And knowing how to fix some things yourself is incredibly valuable, especially for people who might be on the lower end of the income scale, because a major repair might put them in a situation where they have to decide, do they pay their mortgage or do they make this major repair? So being able to do minor repairs is a very, very good thing. NACA also has a home save program. If you already have a home, but you might be in danger of losing it, then you can reach out to them for their home save program, because they have a great home save program as well. But NACA is mainly known for the home buying. And interestingly, 90% of home buyers through NACA are people of color. So they are doing a great service for the culture. So check them out if you feel like you might be interested. And then lastly, I will talk about the Other major thing that people often like to buy and use their good credit for, and that is for a car. And with a car, you can either buy a car or lease a car. And if you're leasing a car, there are some benefits and some drawbacks. You generally get a new car every 3 or 4 years if you're leasing a car, because lease periods are usually 3 years, 4 years. You might find some 2 years. So for those who constantly like to drive a new car, leasing will allow you to do that. With leasing, you can avoid a large down payment as well. And so that to some people is a draw toward leasing. When you are driving a leased car, generally your repairs are under warranty, because usually it's new cars that are leased, and new cars come with a warranty. A lot of times they're 3 years, 36,000 miles. And so your car will generally be covered for repairs if you're leasing. But with a lease, most leases don't want you to drive more than 12,000 miles per year. And some want you to drive even less than that. If you drive more than the allotted number of miles in any given year, they charge you for each mile. And it can add up considerably to where you're paying thousands of dollars in fees for mileage overage. When you are leasing a car, you have to keep it in excellent condition, because when you turn in the car after your lease is over, they are going to then sell it as a used car, and they want it to be in good condition where it'll be able to be immediately sold without having to be reconditioned. So if your car is not in excellent condition, then you'll have those penalties under your lease, your end of lease penalties. Leasing in the long run costs more than buying up front. And it also has the downside that you never stop making lease payments. If you do a 3-year lease, you're paying the whole 3 years. You turn that car back in and get another car, and you pay another 3 years. And so it's a constant money drain on a depreciating asset that you never own. And so that is something to keep in mind with regard to leasing. With regard to buying, it's pretty much the opposite of everything that I just said for a lease. Except that if you're buying a new car, your repairs are under warranty as well, as long as you're within that 3 years or 36,000 miles. But you can drive however many miles you want when you buy the car. Nobody is stressing you about what kind of condition to keep your car in. And there are not all of the other fees that come with a lease. And you can modify your car as you please. If you're somebody that likes to customize your car, that is something you can do on a car that you buy that you cannot do on a car that you lease. There are tips that I can offer and additional information that I can offer on buying a car. There are also tips that I can offer on every other topic that we discussed today. This is just an overview of the different topics that we might be discussing on this channel, some of the different personal finance topics that we might be discussing. And I just wanted to give you a bit of information. If you like some more information, by all means, let me know in the comments, and I'll be more than happy to record new videos answering your questions, or if it's a simple answer, just answer it in the comments for you, because I am here to help you to live your best life and to reach your money goals, career goals, and relationship goals. So thank you so much. I will continue part 2, so keep a lookout for part 2 of this 2-part personal finance series. Thank you, and see you next time.